Welcome to the Group Dentistry Now Show, the voice of the DSO industry. Kim Larson and Bill Newman talk to industry leaders about their challenges, successes, and the future of group dentistry. Visit groupdentistrynow.com for more DSO analysis, news, and events. Looking for a job or have a job to fill? Visit joindso.com. We hope you enjoy today's show.
I'd like to welcome everybody back to the Group Dentistry Now Show. I'm Bill Newman, and we are over 100 episodes right now, so super stoked about that. We're right around 40,000 downloads just with the audio. So whether you're listening to us on Google or Apple or Spotify, we appreciate you. If you happen to be watching us on YouTube, that's awesome too, or you find us on groupdentistrynow.com. We certainly appreciate the 5-star reviews that we've been getting, and always learn a lot on these podcasts. So without further ado, I want to introduce the team from Logan Growth Advisors. We have Bob Winder, Kevin Khona, and Daniel Stark. Guys, welcome to the Group Dentistry Now Show. Appreciate you being here today.
Good to be here. Thanks, Bill.
And what's kind of interesting about this episode is instead of doing a lot of Q&A, and I think some of this has to do with Bob's background as an educator, he thought he wanted to do a little bit, paint a picture. So kind of focus on what's really important to their clients right now. He's going to mention the legs of the stool, which is really interesting. So we're going to get really deep into what his clients are experiencing right now, what's going on in the M&A market and in dentistry in particular, and what really is a good strategy for you, because there are a lot of opportunities now. And I think for especially these doctor-owned, doctor-led groups, it can be a little daunting to figure out which way to go. Strategic partnership, private equity investment, maybe the banks that you'd worked with in the past aren't necessarily lending to you anymore. And so where do you go? So again, Bob, maybe introduce yourself if you don't mind, your background, and then Daniel, if you want to go from there. I'd love to just get your brief bios, and then Kevin.
Sounds good. Thanks, Bill. So I worked in private equity right after the recession, and we were very interested in recession-resistant assets. So, of course, healthcare was where a lot of money was going, this flight to quality. And this was towards more the beginning of the DSO consolidation phase. It had been happening for years and years before this, but it was just feeling like it was getting hot. And so this caught our eye, and we worked on a ton of dental deals, and I really fell in love with the model, growth through acquisition, finding doctors that, were getting closer to retirement age and feeling like this was a good retirement strategy. So much white space. It seemed like a really, really interesting market. So we worked on a ton of different deals. And ultimately, I thought to myself, well, geez, this looks great. Why don't I do this myself? These dentists make it look super easy. So I raised some capital on my own and found a dentist partner and bought a group of dental practices in Texas. And lo and behold, it's not easy. And the dentists that I'd worked with before made it look really easy, but it's not. And it was a really, really difficult experience recruiting and retaining doctors, managing staff, trying to be differentiated in a huge market. It was a couple of years of my life, probably took at least a decade off my life expectancy, but I learned a lot in the process and gained a ton of respect for those doctors that are successful and that do it and make it look easy. During that time period, I had a private equity friend of mine reach out to me and said, "Hey, Bob, I'm looking at this deal. We're going to buy it for $20 million, but it ended up being too hairy, too raw. We're going to pass. We're going to walk away. But maybe I could introduce you and you can help him clean things up and we can save face a little bit." So I said, well, I'm up to my eyeballs, barely making payroll with my dental gig right now. But when your back's against the wall, you just say yes. So I said, yes, let me take a look. Sure enough, really great business, great business, 6 doctor partners, and they were doing some really interesting things. So I took the mandate, said, yes, let me work with you guys, and get you ready to sell and work with private equity. I knew exactly what private equity wanted, had been on their side for a long time. I knew how difficult it was as an operator to effectuate some of those changes. So I thought I could put both of those skill sets together and run a process on the sales side and help these guys out. Well, sure enough, it was a great business. We were able to make some tweaks, refine the financials, get the strategy in order, and ended up selling it for $40 million, in less than a year. And that's when I realized, okay, this is what I need to be doing. This is partnering with doctors, helping them present themselves and get ready for a transaction, and then running a really great process and helping them achieve a victory like that is what I'm good at and what I should be doing. So I sold my dental group and then have been focusing on this for the past 7 or 8 years. In the process, I became a university professor at 2 universities teaching about mergers and acquisitions and private equity venture capital. And even more importantly, was able to find the best partners on planet Earth, Kevin and Daniel, who are incredible in their domains. And I've been super fortunate to build Logan Growth Advisors. We work with dentists, we work with doctors, and help them navigate the complexity of all of their strategic options. And so that's as you mentioned, that's what we're going to talk about a little bit more today. A lot of the strategic options that they have in front of them, what some of those could look like, what they mean, and then what this whole M&A process looks like. So it's a little bit more like one of my classes at the university and less, a specific meeting with a doctor, but we'll field some questions and hopefully this is useful.
That's great. Thanks, Bob. Daniel, how did you end up becoming a partner at Logan Growth?
Thanks, Bill. I started my career at KPMG, which is one of the large accounting firms in the United States. And I was doing accounting and due diligence work, which means helping people like Bob look at companies to purchase back when he was in the private equity world and help evaluate them, look under the hood, find the skeletons in the closet, find all of those nitty gritty things. And I did that for 8 years before my wife and I decided to have a child. And I decided to switch career paths a little bit. Similar to Bob becoming a CEO of his own dental practice, I left and became a CFO of a dental practice myself, not my creation, but one that I helped run. And I became, during that career path, I became a CFO of several different healthcare organizations, but really fell in love with the dental world. The simplicity, not relative simplicity of D codes versus CPT codes and production versus gross charges. And I found Bob when he was looking at another healthcare company and he needed somebody to evaluate it. Because anytime you're looking at a business like that, you need to be able to evaluate it and value it and make sure that you're paying the right price for the right assets.
Thanks, Daniel. Kevin, you're up. How did you get involved with Bob and his team?
So Bob and I were actually classmates at BYU in undergrad together. So I've known Bob for a long, long time, almost 15 years. But I worked at multiple hedge funds where we were multi-strategy focused and also event driven. So kind of merger arbitrage where there's a potential to take private a public company, and looked at not only take privates or a private equity perspective in public markets, but also publicly traded investment holding vehicles like BDCs and BDCs that own and operate SBICs. So I spent a lot of time on investor structures and what are different types of institutional investors. Then ran a thing similar to Bob. I thought I could run a group on my own, kind of do my own thing. I'm not good at running a group of my own thing. I ran a beauty focused roll up in the Northeast, ended up winding it down with, 3 locations, and ended up working with Bob, and it's been a ton of fun. And we've been able to, help a lot of founders achieve a successful exit. Also worked in corporate development for a private equity backed company. I was going through a recap and worked for the CFO, and really interesting to just work with the sponsor and the management team and to, try and maximize the management team's economics in the transaction and see, you have the existing sponsor, the new sponsor, the management team, and a lot of different stakeholders at the table on each deal.
Thanks, Kevin. So before we really get into kind of this theme that we really want to focus on, and see before we start to teach your class, Bob, Kevin, and Daniel, tell me a little bit about like the typical client that comes to you, the doctor founders that you have. Like what tend to be the needs and wants, and is it somebody that has a single location, somebody that has multi-site, combination of the two?
It's all the above, Bill. What's interesting is most dentists today have been approached by either private equity direct or a strategic, another bigger DSO. And so they're getting these inbound inquiries and they're starting to ask themselves, wow, this market seems to be consolidating really rapidly. What should I do? How do I fit in? And those are a lot of the questions that we're getting. And even just a couple of days ago, a doc with 15 practices reached out and said, I'm just got an LOI from a strategic, a larger DSO. It looks really interesting. What do you think? So a lot of times that's what happens is they're hearing this, they're either hearing it from their buddies or hearing it from conferences, podcasts, or they're getting inbound inquiries. And these doctors usually fall into three categories. So one is they're getting a little bit older, they're thinking about retirement. They're not necessarily at retirement age, but they're feeling more risk averse and starting to get these inbound inquiries and thinking, what should I do? How do I fit in? Who should I potentially partner with and when? So that may be the biggest category right now of doctors that we talk to. Another really big category, so the second one is a successful doctor, usually a little bit younger, and started out his career being very risk tolerant, growing rapidly, but now maybe he's up to 10 or 15 practices and has some real net worth tied up in his illiquid business, right? So this is an illiquid asset that most of his net worth is tied up in, and he's now transitioned from being risk tolerant to more risk averse, because now he's got something of real worth and he doesn't want to screw it up, right? And so is less focused on rapid growth and more focused on, I just don't want to mess this up. I want to keep making money. I want to keep, I don't want the wheels to fall off. What should I do? I probably makes sense to diversify, take some chips off the table, but I still want to be at the helm. I still want to have upside, but I want to make this fun again. Right now, it's not as fun as it used to be because it's a lot more stressful. I actually have something to lose now. And so in that scenario, maybe private equity makes more sense, or even a strategic partnership. The third that we see is a little bit younger, more aggressive doc, maybe has 5 or 10 practices, is hitting up against this glass ceiling of debt. The traditional bank lenders that he's using just don't know what to do with him. He's outside of their typical box and is causing trouble in their minds, right? The faster he wants to grow, the more risky it seems for the bank, and they get none of that upside. And so for them, they don't know what to do. They ratchet back their lending. He's already fully personally guaranteed to the loans. He's got tons of opportunities to grow, but he just can't get more funding to grow. So he usually thinks, hey, I need to sell. I need private equity. I need something because the lenders won't work. Well, there's a lot of different options for him too. Private debt is a great option and potentially bridges the gap between where he is now and maybe call it $1 million of EBITDA earnings. Daniel will define that in a minute. That's his domain. And $3 million of pre-tax profit EBITDA, which is really where the whole world of opportunity opens up from an M&A perspective. So in that scenario, maybe private debt is a great option or a strategic partnership. So understanding really the age, the risk tolerance, and the size of the group of practices help us navigate or give advice to doctors as to what their options are and what might make the most sense. But usually some variation of those 3 buckets are where most of the doctors are that we talk to.
So what we're going to discuss today is really how you're helping these clients, which all are different sizes and shapes and at different stages, right? Whether it's, the stages of their career or the stage of growth of their group, how they find a successful merger or acquisition, what that M&A landscape looks like, right? So it can be pretty daunting, and there's a lot of information coming in now, right? So they've got people, some of the big DSOs have their biz development people out there, and they're hounding them. You're perfect for us, so they come directly to them. Let's talk a little bit about, what, as you start to set them up, what does good look like? How do you make yourself strategically look good for, whether it's a merger and acquisition or whether you continue on your own? How do you make yourself look good for a lender potentially?
That's a great question, Bill. And as you mentioned, there's so much information out there right now, and it's confusing. What is important? What does good look like? You go to these DSO conferences and everyone's talking about multiples, right? That's the big term today, is multiples. What multiple did this trade at, or did this sell at, or this big DSO sold for 15 times or 14 times some big multiple? So everyone's fixated on this multiple concept, which is only one piece of the puzzle or one leg of the stool. So as we think about a holistic deal, what is a good deal? What makes a good deal? It's really three components. The first is multiple, as I mentioned, right? A multiple of your EBITDA or your pre-tax profit that goes into a valuation. These are economic terms. But the second is the EBITDA. So at what EBITDA are you actually using to apply that multiple to determine your overall valuation? That is a very subjective measurement. Unfortunately, it should be very scientific, but unfortunately it's very subjective and it can be negotiated. And so we're gonna have Daniel, who is our expert at establishing a defensible and aggressive EBITDA, walk us through what that looks like. And then the multiple, that is really derived from running a competitive process. That competitive tension is magic. So you as a seller, or even someone looking to partner with either private equity or a strategic, another DSO, having multiple parties competing to win your deal, that competitive tension is where the magic happens. And that's Kevin's domain. He is unbelievably good at this and he loves it. He can't get enough of it. So he's going to walk us through what it looks like to create that competitive environment in order to get the best multiple. The third leg of the stool is the terms. So you might get a great multiple on a fair EBITDA, but you might have horrible terms. And so sure, you might have gotten a big multiple, but ultimately it's a bad deal because those are not good terms. And we all work on the terms, but I'll go over that a little bit more as the last phase of a deal where all the terms are ultimately negotiated. And far too often I get accused of being an attorney, which that's okay. I'm not, but we get really involved in that. And just having more knowledge about it, we go over a lot of that in our classes that we teach. Those are the three key components of a deal. And we all, us three partners, kind of take on specialty in our domain. And we're happy to go over that right now with you, Bill.
That'd be great. So just to reiterate, the legs of the stool, we have EBITDA, the multiple, and terms. And so to your point, Bob, you do hear, and you used to not hear this, but now all you hear is EBITDA, right? It used to be a percentage of production, and now it's EBITDA. So the industry is getting a little bit more sophisticated, but that's not the only piece, right? Because if we only had that one leg, we'd be in trouble. So I believe that's you, Daniel. So if you want to talk a little bit about EBITDA and your knowledge about that and what that means for your clients.
Yeah, absolutely. Thanks, Bill. EBITDA, you probably heard it pronounced EBITDA, EBITDA, or 100 different ways. I pronounce it EBITDA, but it stands for earnings before interest, taxes, depreciation, and amortization. That is a very boring accounting way of saying how much money does it make? Because in reality, that's what an investor is interested in. What is the profitability of a business? And it's not the same as net income or even taxable income, because there's all sorts of funky accounting things that we accountants, we love to throw in there, like depreciation and amortization. But it's what it tries to be is a proxy for cash flow. So for how much cash a given company or an asset is generating. And there's another term that some people use called seller's discretionary income, or SDI, which is not generally used by the larger DSOs. What SDI is if you take away all of the operator owners' wages and all of their health insurance and all of their benefits and et cetera, how much cash flow is it making? And it's largely irrelevant unless it's a single owner practice that's generally the owner is checking out, he's retiring and wants to sell that practice to another single owner operator so that that owner operator understands what are they generating. So I'll focus on EBITDA for the larger DSOs, which would include all of the owner compensation, would include all of the dentist compensation. A lot of companies look at EBITDA and they get concerned because there are bumps along the road. During COVID, for example, I think every dental practice in the country was closed from about mid-March through mid-May of 2020. We ran into a lot of founder owners who were very wary about trying to sell in June or July of 2020, or even early 2021, because the key focus of EBITDA is your last 12 months. What does an annual EBITDA look like? What does a year's worth of EBITDA look like? But if you had COVID, then your EBITDA is down. So what do you do in those circumstances? Well, you pave over those potholes. Everybody knows COVID existed. Everyone knows COVID happened. And so you can say, well, had COVID not happened, what does the company look like? What do the last 6 months look like? What do the 6 months after COVID and the 6 months prior to COVID look like? What does that surrounding area, et cetera, or there's other, some of these one-time or non-recurring events or initiatives that you're doing. We ran into a client who had just recently hired a prosthodontist, and a prosthodontist will generate a lot of new revenue for a DSO, but the prosthodontist had only been working for 3 months. So their question was, do we need to wait 9 more months before we can look at and figure out what EBITDA is? The answer is no. When you perform something called a quality of earnings, what it does is it looks at what is reported EBITDA and adjusts those numbers so that the reader can understand at a normalized basis what kind of profitability is this asset generating. It gives a real feel for what it's generating. And even though there's noise, even though there's bumps, even though there's different things, a good provider will identify those, smooth it out so that you can come to a certain number. So I'm going to share an example quality of earnings on my screen. I think if those of you who are listening at home, Bill, correct me if I'm wrong, but they can probably go to the website to download this.
They absolutely should. Yeah. So if you're interested in seeing what a Q of A looks like, you're going to have to go to our website, and we'll definitely in the audio show notes, we'll put a link to this.
Yeah, so what this shows reported revenue and EBITDA for an example company. And for the last 12 months of this, the revenue was 7.7 million and EBITDA was 514,000. Great. Well, those are your reported numbers, but your reported numbers don't mean a whole lot until you've kind of beaten them up and figured out, well, what is behind the numbers? So one of the items that we do, and typically one of the most interesting things you can do, is what's called a cash to accrual conversion. Most dental companies out there, you receive $1 million in a month, you record $1 million of revenue, and you move on. If you're a Medicaid practice, I know that Medicaid pays on Tuesdays and Thursdays. If you had only 4 Tuesdays and Thursdays in a month, well, it doesn't look like a great month. Whereas the next month, you might have 5 Tuesdays and Thursdays, and it looks like a great month. Or you might be growing. And as we all know, production can take 45, 60, 75 days until you start seeing that in your bank account. So the biggest thing that we do, or that any advisor does, is they take a look at that production. They took a look at those collections, and they give you credit for the work that you've done, not only the cash that you've collected. So in this example here, there are positive adjustments that fall to the bottom line. For the last 12 months here, $173,000 of revenue and EBITDA are generated that just haven't come in yet, just simply based on when the timing occurred. The other things that we'll do is we'll look at personal expenses. Your advisor is not the IRS. If you have your spouse on your payroll, you have dinners that you expense through the business, or if you have your personal automobile through the business, to make sure to tell your advisor, because you get credit for those things. I remember on one transaction that I was working on, that initially the client would sit back, fold their shoulders, just go, nope, no personal expenses. And I started digging in, and it turns out they have a yacht captain on their payroll. And obviously that's personal in nature. And as your advisors, the advisors need to know that so that they can, what's called, add that back and get you credit for that. So on here, we have a couple of different adjustments. The out of period compensation, that was somebody was paid in the wrong month. And so we shifted that out from one month and into another. The owner is an absentee owner. The owner is collecting funds above and beyond what an operating dentist would take. So we add those back. And then they had some other personal expenses. They bought some new furniture for their house. They had personal purchases through Amazon. So we go ahead and we add all of that back to make sure that we get credit and give credit to the company, and so that the reader acknowledges that's there. And then there's what's called pro forma adjustments. The pro forma adjustments here take a look at things like COVID. As you can see on the screen, if you pulled it up, we paved over COVID for 2020. This company created a new facility that had just opened about 6 months prior to me looking at this. We pave over that. We take a look at what has it actually done in those 6 months, and we give credit for had it been open for a full year. There was a snowstorm here in Texas back in 2021. You probably read about it all over the news. The entire state was shut down for a week. So we make sure and give credit for that. And then the last adjustment here is that when you start a new facility, look, I get it. You're not profitable right away. You're burning money in advertising. You're burning money in hiring front desk and DAs and training them prior to the first patient even walking through the door. So making sure that you go through all of that and understand each of those items so that your advisor can give you credit for it. You come down to here where we started with $514,000 of EBITDA. And with all of these adjustments, we're at nearly $1.3 million of EBITDA. And getting that right number of EBITDA is important. If you go to market at an EBITDA that's lower than the $1.3 million here, for example, let's say you went to market at $1 million. Well, when somebody puts an offer on your business, and then they're going to dig in the same way that a good advisor would have done so prior to going to market. If you're too low on your EBITDA, they're never going to come up in the purchase price. They won't tell you. So you don't want to go too low. But if we went out, for example, at $2 million of EBITDA on this company, then as they start digging in and find out, wait, there's not $2 million of EBITDA, there's only 1.2 or 1.3 here. Well, then you have some awkward conversations with the investor. Do they still want to do the deal at a new price? Does the seller want to do the deal at the same price? Is the deal going to die in these 3 to 6 months that we've spent negotiating and talking? Are we going to have to go through all of that process again? So it's important to get to the right EBITDA. And it's important to have somebody who understands and has the experience to identify, are the meals personal or business? If it's an office party and it's pizza for the billers that are working late to make sure to get all those claims in, no, that's not personal. Now, if it's the owner taking their spouse out to a fancy steak dinner, yeah, that's probably personal. But you need a good advisor to be able to tell the difference and be able to get through all of the noise to come up with a good, solid, and most importantly, defensible EBITDA so that you can get the correct valuation.
Well, and Daniel, in our early days, we used to do a lot of Q of E's for the buyers, for the DSOs or investors. In your experience doing that, how many times did you see EBITDA inflated that ultimately killed the deal? Or what were some of the adjustments that just don't work?
Yeah, and thanks, Bob. And some of the adjustments that I've seen that have killed the deals are people trying to take credit for things that haven't happened yet or might happen in the future. Or if you buy this and you have your own accounting department, for example, you're not going to need our accountants, so we're going to take credit for that. And that's not how a Q of E is designed to be. A Q of E is designed to establish what is that baseline of EBITDA? What is that number that everything else can be built off of? We came up with, in this example, 1.3 million. Now, if a strategic investor comes in there and looks at, okay, dental supplies are 8% of revenue. Our standard is 6% because we know Henry Schein really well and have really good rates. So we're going to save 2%. We had a transaction where somebody was at 20%. They were doing implants and moved it to the industry standard. And for those of you on the phone, or those of you on audio only, I'm putting my fingers in quotes, move the 20% down to 6%. And those of you who do implants realize that the cost of implants are a very significant part of your revenue. That transaction fell apart. So it's the inexperience in the dental industry or in the specialties, or the inexperience in not performing solid analyses of these companies to identify those one-time non-recurring events or those personal expenses to establish that good, solid, accurate EBITDA.
That's great information. So that was our EBITDA lesson. And then also you got an opportunity. And if you're listening, you've got to jump on the video and actually see what that quality of earnings looks like, because I think it's important to take a look at that. So thanks, Daniel. That's great. Now, as we move on to Kevin and we talk about what everybody talks about now is the multiples, right? And these crazy multiples, at least it seems that way, that we see some 14, 15x and people throwing, what did you get? And what did you get at these DSO meetings, right? So Kevin, can you talk a little bit about multiples and where we are right now and how to maximize that? And does EBITDA is obviously tied to the multiple, right? So you could have an EBITDA that maybe wasn't calculated, right, the best way, and you might get a better multiple, or maybe you don't, right? Maybe they go, hey, here's an opportunity for us to give you what looks like a good multiple on an EBITDA that maybe wasn't calculated like it should have been.
I've been on the other side, putting term sheets out to individual locations and seeing what would stick with a really low offer. And that's just really common and commercial from a lot of strategics. And there are definitely high multiples out there, but it's on what EBITDA? Is it TTM? Is it 2021? Is it 2020? What are the growth prospects? The same EBITDA could trade at a lot of different multiples. So being able to first, I would say as the biggest takeaway, if I'm an individual doctor or own some clinics, the private equity market is much more robust for individual clinics that have stable and growing revenue and EBITDA, multiple providers, $1.5 million plus in revenue. That market is extremely liquid compared to anything that doesn't have those characteristics. So the vast majority of clinicians are much less than that, and that's normal. So maybe a typical clinic that's 700 or 800K in revenue, my best advice would be, come up with a plan on who can you merge with? How can you get beyond 5 operatories? How can you prep for a sale that you can get a much higher multiple because the business is better, right? And so from the private, what I would say is kind of the acquisition market, really 3 buckets, like Bob talked about. I would say you have kind of the strategic bucket that we kind of all know in the different flavors in that market, the private equity or financial sponsor market for buying a majority of the business, and then also the private debt market or syndicated bank debt. I'd almost put in that same bucket because most kind of smaller founders might not be kind of used to that yet. And that market's dynamic. So 10,000 plus players in the US and Canada. Same deal 6 months ago, today, 6 months from now. Who is interested in that is totally different. So strategic maybe have just been acquired by a different sponsor. They're digesting that acquisition. You talked to them a year ago, and today they're not interested in doing a deal. And also individual lenders and individual funds may have a portfolio constraint where they say, man, I'd love to do this deal. I love your business, but we are already at capacity in dental in our portfolio concentration for this fund. Come talk to us next year, in 2 years, or in 18 months. So being able to be broad and concentrated and targeted at the same time is really important. What I would call is kind of how to maximize your multiple is first run a wonderful business that has great doctors that provide phenomenal clinical care, that consistently are working for you, that you have low doctor churn, and you have lots of great providers, and your patients are happy with you, right? So that's, number one, and phenomenal clinical leadership, which is going to show through in all the numbers. Before going to market and having looked through the QV and understanding where EBITDA is and understanding the business characteristics, then you can reasonably say, here's a range of multiples that you could expect in today's market, given, first your EBITDA on size. Walk me through your providers, walk me through your geography. Let me show you a few other characteristics just that we talked through in some of our materials.
Again, for everybody on audio, you're going to have to jump on the video to see this.
So what is the geography? Are you single state or multi-state? What is your payer mix? How much do you have Medicaid, Medicare? Are there Medicare for multiple states, private payers? What is the procedure mix? How consistent is your financial performance? We kind of joke up and to the right, hopefully up and to the right, where your both revenue and EBITDA are growing. How's your doctor retention, right? When you open a new location, do you have a track record of being able to open de novos, or do you have an acquisition strategy? At what multiple are you able to complete acquisitions? If you can complete acquisitions at a lower multiple, then your platform could be more valuable. The market also has some tiers that it's really important to understand that really the institutional market tends to start at about $1 million or $1.5 million of EBITDA. You have a lot more liquid market, which would be kind of the traditional lower middle market that starts at 3 million. Another layer of investors that become very interested at 5 million. 10 million is really where the middle market starts to dip down, and you're at kind of the tippy top of the lower middle market. What I would say is kind of true middle market at about 20 million in EBITDA. And then at 50 million, you've really got the potential to potentially go public, at least via a SPAC transaction. And the lenders kind of are across those sizes. So really institutional lenders where there's not a personal guarantee tend to start at $1 million, $1.5 million in EBITDA. More flexibility, more access to capital at 3 million. At 5 to 10 million, you could potentially start to have syndicated bank debt or even more flexible debt with higher leverage. So those are all points. In terms of what is your procedure mix? Is the procedure mix reasonable? Do you have integrated specialty services in your clinic, assuming it's a GP practice? If it's a specialty clinic, how are your referral parties? Are you integrated with other specialists in your group? Just how are the margins generally, right? How are your staff? Are things in line with the market? And where are you playing geographically? So are you multi-state? Are you rural? Are you urban? Who are your competitors? And of doctor churn, which is, really important. How many providers do you have? Are they competitive? I'll give you an example. I talked to a sponsor yesterday. They only want clinics where the owner doctor is less than 30% of production. Doesn't matter if it's 100 million in EBITDA. Well, that's what their LPs want. They're, another sponsor, they own a great group. It's growing very well. A year or two ago, we talked this morning, they're not, they weren't really interested in another dental platform. Today, they're actively looking in other geographies. So that dynamic changes. And then in terms of kind of who fits in each of those buckets, when you look at strategics, you have founder-owned strategic groups that they don't have a capital or institutional capital partner yet. So maybe they're 3 to 200 practices, but not backed by private equity. You have private equity light groups, maybe, where they have a minority investment from private equity or a private lender, which could be pretty interesting. Private equity backed groups where a private equity firm owns a majority stake. And you do have, one publicly traded dental group in North America. We'd love to take to market the next one, but I'd say that the SPACs are very actively looking at dental groups, which could happen in the next few years with a U.S. group. And then on sponsors or financial sponsors, you have a wide array of what I'd call non-traditional investors, especially in the lower middle market. So in lower middle market, you could think of 1 to 10 million in EBITDA. From a clinician perspective, kind of 1 to 30 clinics or 1 to 50 clinics. Traditionally, you'd have funded private equity firms. They raise a fund that lasts for 10 years. Those groups are still very active, whether they're healthcare focused funds or generalist funds that have a pocket for healthcare. But then you have family offices that are directly investing into private deals. You have mezz equity groups where they're looking at both the debt and equity, which can be really interesting. Also distribution focused groups, which are different flavor, where you can receive monthly or quarterly distributions on your rollover equity. Royalty groups, just independent sponsors, search funds. There's a lot, and those buyers change all the time. There's new groups, and the groups from 6 months ago or a year ago might not be investing today. And then on the private debt front, you have SBIC funds, BDCs, larger regional banks that have dental focused lending, who also may be willing to start to syndicate a loan to allow you to continue to grow. Then you have what I call almost non-traditional private lenders, whether they're investing directly off the balance sheet of a publicly traded company or of a large private company, or just some other structure. So those are a little bit of kind of, the buyers and the factors on multiple, but ultimately bringing groups together who are appropriate for the deal, having that competitive tension and having multiple bidders in a deal drives price higher. A lot of the academic research shows it's typically 20 to 25% higher on the same transaction.
Well, just from what Kevin said there about the different buyers, if you've got a strategic coming to you, right, which a lot of the listeners may, that might be ultimately the best option for you, but it may not be, right? So it's good to look at all of your options, and there are quite a few out there, some that I wasn't even aware of. So and again, kind of getting back to what we initially talked about, how daunting it can be for somebody, that is, a dentist that has found themselves with, a business that they've grown 5, 10, 15 locations, and then they're looking to make the right move. And there's so many options now, and there's so much information. So thanks, Kevin. That was really, really great information. And then let's kind of finish up with Bob, because then there's the final piece, which nobody really talks much about, are the terms, right?
The terms, which are probably the most important, right? So it's really easy to talk about multiple. That's super fun to talk about. EBITDA is a lot harder, but people generally understand what that means. But the terms is just this nebulous black box that you just want the attorneys to sit in a room and figure out, and hopefully it works out okay. But the terms are what make it all work, or what make or break a deal. So you think about the first general bucket of terms, the economic terms. You might get a big multiple on a nice EBITDA, but what are the economic terms of those payments? How much of that is cash at close versus contingent consideration or earnout versus a seller note or rollover equity? Not all of those are treated the same, and they're not all worth the same. Money today, cash in your pocket is worth more than any of the rest of those. Generally, cash is king. But there's a lot of times when reinvesting some of your proceeds into, whether it's a DSO, a strategic that's partnering with you, or a financial, a private equity, because you believe in the upside in the future, what else are you going to do with your money? You might as well put it in your own investment to go forward and make a great return on that. So there's a lot of rationale to reinvest and have a lot of proceeds go to continued ownership. But at what terms? A lot of times what we find is that reinvestment isn't treated the same based on the type of deal. So a lot of times you have a strategic approach you and they say, hey, listen, and I've heard this pitch multiple times. Listen, we can buy you practice for 3 or 4 times because that's the market rate, but we're only going to buy 70%. You reinvest 30% and we're trading at 13 or 14 times. So you're immediately making multiples more working with us, right? You've probably heard that same pitch, Bill, and it sounds like a compelling pitch, but if you think about it, all right, I'm being bought at 3 or 4 times, and then I'm taking some of my proceeds, and now I'm buying in at 13 times, so I'm immediately being diluted, right? And the only way for me to make money is if the enterprise value of the global corporation continues to grow, which we all hope it should, but me as an individual dentist, I don't have hardly any influence on that. So a lot of times we've helped founders come up with structures so they don't have to reinvest at that big diluting multiple. They can keep their equity at a joint venture level or a practice level. And then when that bigger company, the big DSO, trades again to the next private equity, they can then contribute their equity up and take advantage of that bigger multiple. So that's a huge consideration that rarely gets talked about. At what multiple are you buying in at? A lot of times you're immediately getting diluted. Or if you're partnering with private equity, what does their equity look like compared to yours? Do they have preferred equity? Is it convertible preferred or participating preferred? If it's participating, that means their equity gets put in front of yours. And that once theirs gets all paid off, then they get to work with you pari passu. So theirs gets double counted, pari passu meaning equal, versus, hey, we're just in this together. We're equal partners. Our equity gets treated the same. So there's a lot of different flavors of how their equity can be treated or paid off versus your reinvested equity that hardly ever gets discussed. Or an equity group will come in and say, oh, participating preferred that's the market norm. Believe me, you can trust me, right? And so then their equity gets double counted and yours gets diluted. Another one that we love to work on is what's called working capital. So this is a nebulous term that effectively means that you're selling your business and the accounts receivable and the accounts payable are going with the business as is. But it sounds simple, but it turns out to be a train wreck always in these transactions where their calculation of what's a necessary and normal amount of working capital is almost always way elevated versus what it should be. And so it ends up being a reduction of purchase price. And so this takes a lot of accounting wizardry, and Daniel and I go to war and beat our heads against the wall. And it's always a horrible negotiation, but it's just another lever that and I call them equity groups, but it's the same decision makers, the private equity versus strategic. The private equity guys usually own the strategics, so they're the ones calling the shots anyways. So we're dealing with virtually the same negotiation regardless of the buyer. So working capital is always a big one, is always a huge negotiation. And I've lost years of my life negotiating that. Indemnification terms. So this is how risk is allocated post-close, how a buyer can claw back economics after the fact based on various things that could happen. And the attorneys love to go wild with this. They'll run through what I've heard termed as the parade of horrors. They'll go through all the worst case impossible scenarios and scare everybody to death and sometimes try to kill the deal because of all the crazy scenarios they can come up with in this indemnification bucket of how risk gets allocated. But it is extremely important. And there's a lot of negotiations that happen to try to come up with a fair allocation of that risk. So incredibly important, need to be very detailed on that. Non-competes, doctors are always allergic to non-competes, and that's always a point of discussion. Future employment and future obligations, that's a huge piece of this too. And contingent payments. How much of that 15 times multiple is contingent on performance over the next 5 years, right? You know, as a buyer, I'll happily give a 15 times multiple if you guarantee 20% EBITDA growth for the next 20 years. Like, I'm all about that. That sounds great, right? So it's one of my favorite attorney friends. He puts it in these terms. He says, "I'll agree to be hanged in the town square as long as I get to pick the date," which of course is going to be 150 years from today, right? So the terms, like, you can agree to the price, you know, if I get to agree to the terms are just as important as the price. And of course, price is made up of EBITDA and the multiple, but all of these make up the legs of the stool. They're all equally important. And any one of those, if it's not done correctly, can really make or break your deal.
So we got the three legs of the stool there. And I think I initially said that we were getting at like an M&A, dental M&A 101, but I feel like this was like 101 and 201. And maybe with the third leg of the stool, it was 301. So we got our freshman, sophomore, and junior education on dental M&A today. Thanks, guys. This was great. So Bob, Kevin, Daniel, appreciate your time. Bob, if somebody that's listening or hopefully watching with all the great, information that you shared with the Q&A and some of the information that you shared, Kevin, somebody's watching this and they want to get in touch with you, Bob, or somebody on your team, or just find out more about Logan Growth Advisors, how do they do that?
Email me, bwinder@logangrowth.com. Go to our website, logangrowth.com. Love to hear from you. One of our favorite things to do is a whiteboard session. So we'll pull up a whiteboard, put on my professor hat or an Excel spreadsheet and just walk through scenarios, economic scenarios of these potential arrangements and what they could look like for you to help inform better decisions. Because people get approached by strategics or private equity with offers, with terms. Just to put that in perspective, what does that look like compared to what are other options out there? Just to help inform people to make better decisions. We love that. So would love to help out in that way or any way we can. bwinder@logangrowth.com.
Okay. Well, thanks, Bob, Daniel, Kevin, and thank you, everybody, for watching us today. We appreciate it. Until next time, I'm Bill Newman, and this is the Group Dentistry Now Show.
The Group Dentistry Now Show has listeners across North and South America, Europe, Asia, and Australia. If you like our show, subscribe today, and please tell your colleagues about us.